Good morning. I'm Dan Hussey with Zaner Ag Hedge, bringing you a strategy day update here for July 19th, 2022. Remember, trading futures involves risk, is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. But if you are interested in trading with me or hearing more about what I have to say in the markets, do shoot me an email, dhussey@zaner.com. You can give me a call at 312-277-0110 or sign up in the links in the information section of this video to join me for this free Strategy of the Week webinar every Thursday at 2 p.m. Central, where I cover more actionable trading ideas and strategies in more depth, a lot more about the markets as we go over the markets for about an hour there. With all that being said, okay, a little red on the board here today. In the corn and soybean markets, we're going to kind of concentrate on those two in this quick video. Crude oil has popped up here today, finding resistance into some key levels that we'll talk about in a moment as well. But I think we have kind of technical price action playing out in a range, and this type of range at lows could be considered a bear flag, but it could also be very much like price action from last year, which we've looked at in prior videos, where we went very range bound to slightly lower in this period from July through September and August for corn. And then we found a harvest low into late August, early September, and then headed higher. Beans obviously had some rallies and short covering during that period, but ultimately didn't find their harvest low until November, until harvest was pretty much complete. At that point in time, we're really talking about trading more of weather markets for corn. That once we got through the key weather season and harvest began, corn found its lows. But we needed to almost, beans are such a hand-to-mouth export type of commodity that we almost needed to see how much was actually produced, as well as needed to see some of that export demand last year come back in October, November, which started up and lasted through the highs in March and May. Before we begin on the charts, let's just take a quick look at weather. Our higher altitude, wind flow maps are showing, nice cool air blowing in from the northern, from Canada. That's meeting, this stream of warmer, moist air coming up from the Gulf. Moist is very is very misleading, I guess, because it is, of course, very dry coming from this Texas, Oklahoma panhandle region, which is incredibly hot right now. But the warm air hitting the cool front is a big reason, right? We're getting these storm fronts and cells that are forming over North and South Dakota and Minnesota and being pushed down over Illinois and Indiana and Wisconsin and parts of Iowa at this time. So we're getting, I would say enough rain in some places to carry us through. And that's really discounting the hot temperatures that we've seen. And now, we're getting forecasts for not as hot. Rainfall over the last couple weeks, or last week. This is 1 week of rain data here. Most places got some sprinkling across the Midwest, with the most of that rain being, through Minnesota, Wisconsin, Illinois, and into that eastern Corn Belt. The eastern Corn Belt really needed this drink. All my clients in in Indiana and Ohio, were talking about how if this didn't come, they would have been really, really sitting bad. But they did get enough to now, kind of carry them through for another couple weeks, and certainly through pollination. And if we go back to the week prior, the 5th through the 12th, we were getting a decent amount of rain in that western Corn Belt. That again was enough to kind of carry things through. This is, of course, discounting what's going on in Kansas and Missouri and Oklahoma and further south. That is a very different situation. The heat dome and drought conditions with extreme heat is certainly affecting things there. But my point is that we were all looking for extreme weather markets, and we have to be honest with ourselves here. They didn't really come. We got just enough to pull through, in my opinion. So we'll see how that carries out. That doesn't mean it's going to stay that way. The 6 to 10 day precipitation forecasts are calling for near normal to above average for that eastern Corn Belt, but near normal rains for the 6 to 10 day outlook. The 8 to 14 day, kind of similar, but a little drier out west. Nevertheless, we'll continue to see what happens there. This maximum temperature forecast was the real scary 7-day forecast that we were looking at. Over 100-degree heat for much of the southern plains, 90-degree heat through the Midwest, and staying relatively cooler there up north. But this was a lot hotter and a lot redder a week ago than it is now. And something that I don't necessarily want to forget, and I keep calling to attention, is this minimum temperature forecast for the next week. We still drop down into the 70s in most places overnight, so we're not stressing the crop for 24 hours of the day, which again is another change here in weather and shouldn't be totally discounted. Those 6 to 10 day and 8 to 14 day forecasts still above normal temperatures across the Midwest and through all of our growing regions. But again, with that little bit of rain we got, these heat units could be seen as a good thing for production to some extent in many places, and that's probably why we're seeing some pressure on the board. Okay, fundamentals aside, we're still in a late planting year. Yields are still not going to come out to where they were originally projected, and I still think we've seen the highest yield numbers from the USDA. Our next WASDs, we will see them come truer, I should say, on those numbers, because they're still pulling kind of numbers out of thin air, but I think they're going to have to do something with yield. Now that we've got a firm, acreage number, which for all intents and purposes was relatively bullish, I think those yield numbers are going to come back more bullish over the next several weeks. Whether or not that's going to cause, a big rally on the charts is another thing altogether, but we do have some technical developments on the charts that I think are weighing on prices and are getting, we have to acknowledge that there are fund and speculative traders out there that are trading these charts based off of just these technicals alone. Starting with November beans, I think a reason we saw some pressure here today was that yesterday, even in the even that nice rally we had up to test the 18-day moving average and found it as resistance at 1388. Now is about 1390 yesterday. Found it right into that red line. One of the reasons I think we're getting some technical selling and probably some down pressure today is this bearish crossover of the 55-day and 100-day moving average. The 55-day is now below the 100-day moving average. That's a technical sell signal to many funds. You probably had long liquidations. And the failure to get back above this 200-day moving average at 1380, not a great look. We did come up. We didn't hit overbought conditions here in the daily RSI. We only got to 75 here. But that leaves room for the upside in case this market does reverse back higher, get above that 200-day. And I think that 1390 to let's call it 1390, 1400, 10 cent range now is very important to see the market reestablish back above to then, see continued short covering and a rally higher. The rally we're seeing off the lows today, about 18 cents off the low currently, is a great start to that. I don't want to say the T word, but it is a Tuesday, and it may turn out to be that type of day. But we can't discount the idea that we are very much in range-bound price action right now for the entire month of July. And I think when we look at the smaller time frame charts here in a minute, you'll see that clearly as to why I'm sticking with the range bound price action for the time being. We can certainly get up to $14.50, $15, but going above those thresholds, really doing a breakout to new all-time highs with the current weather situation we have, I just don't think it's possible without a shift in forecasts, right? If these forecasts, we get no more rain and things get really hot and dry and this becomes 2012, okay, different story. But every single day, it seems like we get a little bit of news against that idea, and it's not worth betting on it coming. We are still below that old range that we held from February through June. That was around the $14 mark. We found lows. We bounced up. We couldn't break through 16. We came back down. This is just price discovery to see where support is. We came back down to test those old highs from last year around the $13 mark, and now we're finding ourselves in a range between these technicals and what is otherwise a very lackluster price action in the time being. But there's still something to be said in terms of what's going on in the near term. So again, good rally, about 20 cents off the lows right now for the soybeans. I will admit we have to draw up on this chart from yesterday's high to today's low now, that 50% area that we want to see this market, trade through. I don't foresee us holding resistance at 1365 necessarily. 1375 would break it, and 1375s would constitute, the range playing out as we see it. So let's go back here in time for just a minute. We had broken trend lines here. We came down to basically test that broken trend line now as support. We also had broken trend lines from this 3-day range here. We held as support. So that's a good inflection zone around 1340 that's held. Okay, cool. Doesn't do us much. Can't really make money off of that. But what I really want to show you is that this range from basically 1508 highs down to 1302 lows, 50 backs in this range just haven't held. The 50 back short didn't hold. You could argue, we came up to it, gapped above it, hit the 61.8 line, but then we fell all the way back down to test range lows. So we did a 61.8 line break, and then immediately came down 2 days later and broke the 61.8 line of a long off the lows. That's what started, in my opinion, this range sideways. Whenever we do 61.8 lines on both sides, you can almost draw up trend lines against the highs and lows, and the market will just start bouncing between them until it breaks out. And you get this coiling that's happening. Coiling isn't bad. It doesn't tell us one way or the other the market's going, but it does build up potential energy that the market can break out or down from. And as a trader, we just need to be aware of all the potential situations that can occur here. After coming back down to test that 1320 area here last week, full 50% shorts off the highs from 1440 basically down to the low at 1315. We came back up yesterday to test the 61.8 line at 1390, and immediately we came right back down. You would have hoped to see the 50% long from the 1315 low to the highs here today hold. You can see they kind of front ran it, maybe got a little reaction off of it, but forces that B pushed it down to the 61.8 line below. This is all indicative, again, of range bound price action, sideways price action without a lack or clear direction right now. That doesn't mean it's bearish or bullish. It just means we're probably going sideways between 1440 and 1320 in that $1.20 range for some time. And even today, I anticipate maybe the market squeezing back up now again for the same reason up to that 61.8 line to break around the 1371 area, which to me would take all the pressure off from the bulls and put a little more pressure on the bears. But it would also, again, say that, okay, we're not falling out of bed here. We're probably, going below 1340 at this point, going below 1320, and certainly below $13 is not something, is equally as, it has an equal chance of us going to 1420 or 1440. Okay. So pointing that out here, very choppy sideways price action. We'll see how this continues to play out on the short term for the beans. I'm still using this opportunity or this sideways price action to pitch re-ownership strategies to clients with the idea that if we do get up above 14, 14.60, $15, the long calls or call spreads that you have on from down here can be used as an opportunity to do some more forward sales if we haven't done them already. From a speculative standpoint, though, right, we're taking risk. But then as we go higher, and yesterday and actually last week, as we push above $14, my gears shift from being, trying bullish strategies to actually doing what we refer to as risk reversals. For producers, I'm advocating buying $13 puts at that time, selling like a 1520 or 1540 call against it. We were doing that yesterday was for about 3 cents. Last week it was being done for even money or even a slight credit to you. The idea is that, okay, as we go back up in this range, let's get a floor in the market, okay, and sell some calls above so that if we do go up to those strikes, you can go to your elevator, get a basis contract locked, and now that $15, 1520 short call can become, your first sale or a sale this year. All along, we're forwarding and you've paid for a $13 floor. So if we do break down into November, you've got that floor in place for you. So I'm playing both sides of the coins with clients over this last week. It's a range-bound price action. There's no reason to be a bull or a bear, but we're strategically trying to use the up and down price discovery in this market to try to position when we were down at the low end of the range, which we're still coming up off of today, with kind of courage call type strategies or re-ownership strategies if we want them, and then using pushes up above $14 specifically. I'm hoping we get to 1440 to 15 to really hit the nail hard, with then being able to do maybe $14 puts and selling $16 calls, as we move higher. And again, none of these strategies are static. We're constantly looking at how we can manage them, buying back the short calls, rolling up the puts, rolling up the calls, etc. There's all things to do, but those are all for discussion to have with me. 312-277-0110. Give me a call, and we can discuss them in more detail. All right, so let's move on to December corn now. Didn't want to give that much time talking about beans, but here we go. December corn also getting close to that bearish crossover of the 55-day, 100-day moving average. Has not happened yet, But after today's price action into the end of this week, I think that is the writing on the wall, is that will occur. That's going to keep a little technical pressure from funds and other big swing traders that try to trade these things. But corn, just like beans, very sideways in a range. The breakdown today, we're retracing it nicely. We're already, over 10 cents off the lows. That's a good start. Holding a little bit of a trend line here against the low as well. We'll look at that in a moment. Corn came right back down into that old range that we were holding last year, holding it as support, and we're coiling up now below the 200-day moving average. Yesterday we found the 18-day moving average and the 200-day as resistance up into that 620 area. Certainly we get back above there. I think short covering will occur, get us back to 660, and probably, we're due for a test back up to the 55 or 100-day moving averages at this point, in my opinion. Corn got a little bit more overbought there yesterday into the 770 area, not into the dollar or technical overbought territory. So still very much in no man's land from those daily technical indicators here for corn. The short time frame, man, it's almost the same thing to be said here for the corn than the beans. The only difference is the corn from 660 high, 658 high down to the low, basically the highs of the month of July down to the lows of last week. We did trade in choppy price action up into that 50% short at 620. This is the one red flag I have on all of our charts, is that we held a 50% short here for corn. I would like to then now, if we go up to 630 from here, that's off the charts. Who cares? We're in the same type of sideways choppy price action we have in the soybeans as we do in corn. But corn arguably has held some 50% shorts. Front round the 666 area there in that gap up. I would have liked to seen it actually get there. If you drew from this swing high to low, it traded a 50% almost to the tick. But I go from the highest high to the lowest low in situations like this. But you can't discount the fact that unlike soybeans, the corn has not broken those 618 levels. The one thing corn has done is left these open gaps at 730 and 673 on December's contract. So getting back up to those levels, I think, is just a matter of time. But it might take into after September to do so, like we saw last year. All right, so today's price action, because we've held this 50% short off the high, the market came down and showed no love to a 50% short long from the 57 low to that 620 high. We really do need to draw up on the chart a 50% short here in resistance at $6. If we get to 610 and make a new high for the day, changes things. We go to 630, really changes things. The bulls really need to see that happen here for December corn. Otherwise, I'm fearful that we have a low or a trend line here against the lows that could break around 580 today, and are holding 50% shorts that have downside targets that would take us to new lows. I hate saying it, but I almost would hope the market goes down to 540, 520 and then bounces, just to clean up and take all of the ammunition that the bears have spent here out of their pockets. And then the market can rally. But, I think corn's trading a weather market that it's unsure of what to do. We have high temperatures. We've gotten some rain. Things could shift over the next 2 weeks and change everything. We all know that, weather is as good as the as good as the moment it's forecasted. And every minute after that, that forecast degrades and becomes less and less of a reality in one way or the other. So with all that being said, choppy sideways price action still going on here, but the relief rally we're seeing in corn, probably back up towards the $6 mark, is not out of the question here. And again, we're going to be looking to see if corn breaks through. The last couple days we've been, I did advocate for 620 calls, selling 720 calls. In a call spread in the corn. I don't hate that idea for reownership. We just got to get back to highs yesterday for it to start to go into the money. And today's dip was honestly a good opportunity to probably put some of that on. The other side of that coin, though, is that I think having owning a 560 put while selling 720 calls or something to that effect also makes sense in this environment. How much higher above $7 will we go before we get into the harvest time frame or through a harvest low? I think we're rather limited in how high corn can rally right now without severe weather effects. So I'm comfortable selling calls above to finance buying puts, but I'm also not comfortable enough to go long futures or buy just an outright call, hence call spreads for reownership. Buying a put at 560, selling calls above to help finance that type of trade is still the idea that I'm running with in this environment, because I still think having protection before we get to $5, if we go there, is important in this environment. And we can't ignore the fact that there are some technical reasons why the bears are have been somewhat in control of the charts the last week. Granted, they haven't been able to push through the key levels to the downside to really start a downtrend. And the bulls are, commercial buying, and there's definitely interest here in corn 580 to 560 from the buyers. The last 2 weeks have shown that. And that's a big reason why I think, obviously, we're getting some support here. We found, period of price discovery to find resistance, to find support, to find resistance, to find support. And now one of these resistances and supports will break. The coiling I'm talking about in these charts is what I really wanted to point out in today's video, because into Thursday, we'll probably have a break one way or the other, given how tight the market's getting. And so into the end of this week, in our Strategy of the Week video, Thursday at 2 p.m., we'll probably be able to highlight a little bit more of what the trend's doing outside of these ranges. We'll have a little clearer idea of how weather's affecting really now into the peak tassel season and peak pollination. And I think the market will decide one way or the other to go. I think downside is still limited on these charts. I don't see soybeans necessarily going below, like, to the extreme side, $12 or $11. I don't see corn really getting too far below $5 if it goes down there. But I think to the upside, we're equally as limited at this point in time, because, to be fair, the market already gave us all the opportunity to do sales at the highest prices in the last 10 years. I don't know if it's going to give us that ability again until we get into and through the harvest timeframe and next year. So all that being said, look for reownership at this time. I'm looking out towards March and May. I'm going further out because I think we'll have enough time to get there. And if seasonality continues here, these are great. This is a great pricing area to get those longer term reownership strategies on. But in the near term and through December, November, and maybe even through January for the beans, but definitely for November, December, I'm also looking to find ways of buying and affording a put by selling calls above to get us some protection in the near term. Because if prices do what they did last year, we went sideways to slightly down for another month or so for corn, for another 3-4 months for beans before finding those true lows. All right, and last but not least here today, before I let everyone go, let's just take a quick look at crude oil. We've actually had a decent bounce in the market. This is 3 waves down, in my opinion. This is a correction in crude that tested to 90. I was looking for 86. That was my kind of magic area, 86 to 85, where larger slope trend lines were coming up. It was a 60-1/8 line of this bigger swing. It would also been equal legs down. This leg from 130 down to 92, you measure it off of 123, it came in at 86. So we're still kind of in a channel, our trend channel lower for crude. The next in the series short for crude was at 97 to 100. We've come up into that resistance. If we break back above 100, certainly break above 102 and 105, I think that the low is probably in at this time for crude. But if we do hold resistance here and roll back on over, look for that downside push to 86. And if we find support around there and start to bounce, then I think the downside correction could be completed, and crude could then at that point have swings up to the 150 area. But we can't discount the idea that we are in a downtrend right now, a multi-week 2-month downtrend right now, with trend lines coming in around the 100 to 102 area, resistances around that same area, and right now resistance proving where kind of where we're expecting and looking for it to be. So, we're just tracking the footprints in the sand on the downtrend in crude. I do think if we, pushes back above 100 to 105 in crude oil, will spark some buying in corn and soybeans, particularly probably more corn at this time of the year. Really get that ethanol idea back on the charts. But if this could be another reason, since mid-June we found a top in both the row crops and in the energy markets. This could be some of that inflation trade still unwinding, and certainly a correction against that inflation trade that we've seen. So keep an eye on that. $100 in crude seeming to be a very important level right now that the market's trying to chew through or get back above. If it can't, I think down to 86 we go for crude, and that also could weigh on our row crops. One last thing here is that these triangles, or these sideways kind of wedges we have in both corn and soybeans at this time, down here at these lows, below $14 for the soybeans, below $6.40 and $6.20 for the corn. If we do get another push lower, sometimes from a technical perspective, that push could be considered terminal. So keeping an eye on that in the near term, for capitulation if we did break down. But that, again, ranges don't mean we're going to necessarily go in that direction, but we have some key levels on both the top side and bottom side to look for, for maybe hinting of those breaks that I think by the end of this week, and certainly hopefully by Thursday's Strategy of the Week webinar, we'll have more to say on that note. So with all that being said, everybody, thanks for joining me here today. My number is 312-277-0110. You can find me on Twitter. Follow me on Facebook. Shoot me an email, dhussey@zaner.com. Would love to talk with you more about how we can turn some of these ideas on the charts into actionable trading strategies and risk management plans for you. And we cover everything over here at Zaner, more than just the row crops, even though I specialize in that and happen to work with a lot of producers in that area. If you're interested in trading other things like precious metals, energy products, equity indices, we do it all, and we're here to help you with your trading needs. Have a great day, everybody. Sign up in the links in the comment section below to grab our free Zaner Daily newsletter, or to join me for the free Strategy of the Week webinar held every week at 2 p.m. Central. And we'll be back with you as price action develops. Take care, everyone.